Micron delivered exactly what the AI bulls needed yesterday: a powerful earnings beat, upbeat guidance, and renewed confidence that demand for memory chips and AI infrastructure remains exceptionally strong. The results boosted appetite for technology stocks around the world after days of heavy selling, but unfortunately the celebration may be short-lived because today's US GDP and, more importantly, the PC inflation data could quickly shift investors' focus back to the unpleasant prospect of higher for longer interest rates, which on their end haven't been good for the increasingly indebted big technology companies and investors' appetite for these companies over the past few days. So, welcome to Swissquote's daily market talk. It's Thursday, 25th of June. I'm İpek Özkardeşkaya. We will talk about tech and global macro, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
But first, let's put everything in the macroeconomic context. Yesterday was marked by steadying in the technology stock sell-off and further rotation toward the non-technology European indices, where the CAC 40 in France led gains. The STOXX 600 also printed a small advance during the session, while the German DAX underperformed its European peers due to a nearly 19% plunge in Rheinmetall's share price after the news that the German government changed its plans to buy 6 huge warships, and Rheinmetall was supposed to win that contract. TKMS, which is a domestic rival, rallied 16%, however, expected to supply 4 smaller warships to the German government. But besides that very specific news, the macroeconomic setup remains favorable for European stock markets. A benchmark for the European 10-year yield fell to 2.86% yesterday. That was the lowest level since the 10th of March as oil prices kept falling, softening the ECB expectations. US crude slipped below the $70 per barrel mark on news that vessels are now transiting the Strait of Hormuz with their satellite signals on. And not only, a combination of strategic inventory releases, a collapse in demand from top buyer China, and a substantial number of tankers sneaking dark out of the Persian Gulf had contributed to a small oversupply in some key markets, according to traders that Bloomberg interviewed. That's excellent news for those who are looking for further weakness in oil prices, and that's in line with my earlier forecast that oil prices will likely swing between $60 to $80 per barrel range in the coming weeks and months because geopolitical risks still prevail, as Middle East is never a calm sea. Chinese will eventually start tapping back into the oil market as the tensions in the Middle East ease, and countries that have been releasing these strategic reserves will eventually start replenishing these reserves to counter a part of that extra oil supply. But in the medium run, the IEA has also warned that the end of the Middle East tensions, the settlement of the dust in the Middle East region, and coming back to normal times, we will eventually continue to see demand slow and supply quite ample, which actually hints at further cheapening of oil prices toward the $50 per barrel level on the back of this expectation of a supply glut. So that's my forecast for the next 12 months. Lower oil prices if everything in the Middle East goes well. So that is good news for the cyclical European indices that have been grappling with rising energy prices since 3 months. That also led to a European Central Bank rate hike earlier this month, remember? And softer energy prices should also help tame inflation expectations for the other parts of the world, including the United States. Indeed, the US 2-year yield that best captures the Federal Reserve rate expectations is to 4.13% mark yesterday after hitting the highest levels in a year and a half, remember, earlier this week. The latter didn't necessarily give a smile to technology-heavy US indices, where the price action remained flat, with the S&P 500 printing a 0.10% decline as Nasdaq 100 retreated another 0.43%. But don't worry, because the sun is shining big and bright this morning again on technology stocks, as Micron's earnings announcement yesterday after the bell went pretty well, to say the least. The company announced strong results as expected, but more importantly, they comfortably beat the Wall Street expectations on both the top and bottom lines, with a revenue nearly $41.5 billion versus around $36 billion expected by analysts. Adjusted EPS came in at more than $25 versus about $21 expected by analysts, while the guidance for the current quarter was also very well above expectations. The company expects to make around $49 to $51 billion in sales this quarter versus around $45 billion expected by analysts. Let's say it, it was hard to find a reason to take profit after such a strong beat. So the stock jumped 15% in the after hours trading, sending the stock price to about $1,200 again and lifting sentiment across the rest of the AI and technology stocks as well. As such, the Korean Kospi is up by nearly 6% at the time I'm talking here this morning, with an index volatility that goes beyond imagination. SoftBank, on the other hand, which is another proxy of the AI trade, is up by 6.40% and rising, while Nasdaq futures are leading gains into the European Open. At the time I'm talking here, we are just before the European Open. So is the technology stress over? Possibly. Micron earnings is giving a sugar rush to tired technology runners this morning and shifts the narrative from the massive AI spending, increasing the finance by debt in an environment of rising borrowing costs to very robust demand for chips and data centers indeed to shoulder the rapid AI adoption, but just for a few hours, because do not uncork the champagne just yet. In a few hours from now, the news headlines will be flooded by economic data from the United States that could eventually reverse the positive mood that we see this morning after the Micron's results. Because later today, the US will reveal its latest GDP and inflation updates, and focus will be on the PCE and core PCE figures, which are the Fed's favorite gauge of inflation, mind you, especially the core PCE. So the headline PCE is expected to spike past the 4% mark year over year in the month of May, in line with the CPI released earlier this month, while the core PCE, the Fed's favorite gauge of inflation, may have risen from 3.3 to 3.4% year over year. Both figures are significantly above the Fed's 2% inflation target and rising. And well, the US inflation data has gained all of its importance since the new Fed chair Kevin Warsh decided to put price stability at the center of his monetary policy last week, remember, which came as an important hint for the Federal Reserve and the Federal Reserve watchers regarding the Fed's focal point for the coming months. Fed will be fighting to bring inflation back to the 2% target, or at least back to the easing path toward that 2% policy target. So the reasoning is always the same. A softer than expected set of inflation figures today from the US could temper the hawkish Fed expectations, along with easing inflation expectations thanks to the falling oil prices that look to be sustainable today, while a set of stronger than expected numbers could further fuel the Federal Reserve hawks and reverse the post-market optimism across the financial markets, bringing forward the unpleasant topic of rising borrowing costs at a time when the big technology is taking on an increasing amount of debt to finance their AI ambitions. As per the GDP data, the consumer health will be the most important ingredient to watch, if you ask me, as US growth is becoming increasingly shouldered by manufacturing thanks to massive AI build out. And in the short run, the latter boosts growth, and that's good news, but in the longer run, a healthy and sustainable economic growth is achieved when consumers feel good. A thing that China couldn't achieve, mind you, which is weighing on their financial markets heavily today. Now, speaking of the AI build out, the competition is rising among AI enablers, whether it's for building AI models, data centers, or building chips. In that context, OpenAI announced yesterday that it has designed its own chip, the Jalapeno chip. They did the core design aimed at inference being just running the already trained models, and Broadcom helped them with specific knowledge regarding the chip architecture and connectivity and specific stuff like that. Broadcom said that the first chips will be used at Microsoft and other partners by the end of this year already, and OpenAI added that the real volume will come next year. They are looking to power 10 gigawatts of compute by 2029. It is the equivalent of roughly 9 to 10 nuclear reactors. Huge business. And they're not the only ones. Meta, Amazon, Google are all designing their own chips to reduce their costs and secure supply as well. And as competition intensifies among traditional chip makers and newcomers, the AI chip market is becoming increasingly fragmented, with everyone taking a slice from the pie. The question is whether the pie can grow fast enough for everyone to still end up with a big slice. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.